Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. Let's take a look at some legacy TradFi and macro information data and charts today on this glorious Monday, starting with the digital asset fund flows report from James at CoinShares. As expected, we had outflows last week based on the US ETFs, minus 206 million. And again, for the past 5 weeks, we haven't really seen much of anything as far as inflows. So unsurprisingly, price is also sideways. One is not necessarily a function of the other, but from a sentiment gauge, there's not a lot of urgency from investors up here to pile more money into the Bitcoin ETFs, for example. Still seeing outflows from GBTC, outflows from some of the ProShares products, and iShares still on a 69-day inflow streak. If they have another inflow day today, they will be in the top 10 streaks of all time for ETFs, according to Eric Balchunas at Bloomberg. On the flows by asset, continue to see outflows for ETH relative to SOL, relative to some of this other stuff. And we just aren't seeing institutional folk grab ETH with both hands and get excited about it here. Doesn't mean ETH can't go up, doesn't mean ETH won't be bullish in the future, but I do think it hints at sentiment and expectations around some sort of ETF this year, and or just price expectations, yield expectations around Ethereum. Just not a lot of enthusiasm at the moment for ETH. By country here, nothing super remarkable. Most of the flows are going to be United States based, although Canada did have a nice little injection, 30 million in USD terms. Something else to watch and maybe pay attention to would be the BitX 2X ETF fund flows, which individually are still fairly positive. So on the fastest of fast money, we aren't seeing negative sentiment. We'll just say it like that. Based on fees and eventual price performance, the new 2X spot ETF, probably a better deal, BITU. Still very early days there, but just something to monitor. Going forward, if you approach TradFi and include crypto into a portfolio, decent little product, up and coming there. And then if we look at the cumulative 30-day flows, all the fun and excitement sort of happened, right? And again, this is just another way to look at that weekly graph. But we do tend to have this on-off phenomenon where if we're bullish, we're really bullish. If we're bearish, we're really bearish. And everybody decides with their hive mind what to do. In 2020 and 2021, a lot of that was GBTC flow related. We had MSTR coming online at that time, Tesla later on. Thus far, we're not really seeing many new corporate treasuries announce anything significant around Bitcoin or ETFs. The 13F filings haven't really got a lot of press or excitement either, so it's still going to take some time. I'll put a link to this in the description of the video. Great little summarization of the global flows. And then here's gold. Unlike BTC, at least BTC has had inflows on a 30-day basis to a large degree, whereas the gold ETFs have not, and still have not, which to me is a bit unusual. Usually when you see prices rising, eventually you see flows coming in on the ETF side of things, and we really have not seen that for gold. So who's buying here? As I said yesterday, people think it's central banks, China, India, other Asian countries, lots of possibilities, but gold is giving a bunch back today, especially against Bitcoin. Trend on the daily, the gold BTC chart, still remains bearish, has largely remained 100% bearish since January 2023. There was a little excitement here from the risk-off rally thanks to geopolitical issues going on. But Cloud still says it is not ready for bullish continuation. It is not ready for bullishness. And you can see it get denied at the Cloud there for several days and now is spiked lower. So until this closes back above the daily Cloud like it did in September, then you can say maybe it has a chance. But largely overall, Bitcoin, maybe surprisingly to some, is still favored here on trend over gold. And we had this headline today as well, TradFi and crypto slowly morphing into one here, with the New York Stock Exchange polling people, asking for a 24/7 exchange, whether or not that would be worth it to them. A lot of this stuff is automated anyway. A lot of this stuff outside of normal market hours, certainly automated, low liquidity. But of course, us in crypto land, we know all about that. We have been 24/7 since day one. Before we go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Non-investment advice: crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DBA, Kraken. Bitcoin here has curled up a little bit, quietly over the weekend, slowly but surely taking out highs here. Broadly, to me, this still just looks like chop. We're in a massive, massive range. You could argue all sorts of patterns. The one that makes the most sense to me would be some sort of inverted head and shoulders here, trying to peek our way above the 4-hour cloud. Some alts also doing fairly okay today, near 17%. Pepe, crowd favorite, 17%. I think I saw Bonk somewhere on this list that was doing well. So new week, new market. I don't think much has changed overall. We're still waiting to see if we get more sellers at all-time highs, right? That's really ultimately going to cap this. We certainly don't have buyers per se on the flows. Sentiment in general, not super exciting here. Most of the halving gains come months after halving. So everyone thinking like, halving day is going to be super exciting. Not so much. That's not how it's panned out historically. Looking at the calendar for the week, lots of earnings on the Mag 7 side. As far as numbers are concerned, GDP on Thursday, PCE on Friday. Those are certainly going to be the big numbers. GDP has continued to remain positive on a quarter-over-quarter basis. On a quarter basis, based on the NBER's definition of a recession, we are nowhere close to that. So the doomers with the flames in their thumbnails can keep dooming because that ain't happening anytime soon based on GDP prints. Looking at Truflation, we continue to deviate from US CPI, depending on the inputs here, on what they change, which data they get. This isn't sort of set in stone like CPI is, but all in all, it has come down quite a bit. It is sort of cruising at the Fed's target. CPI is a different basket than Truflation. PCE is a different basket and weightings than Truflation. Core PCE is different, right? All these are different. It's just a matter of, in aggregate, are we headed in the right direction? Are we at the target or not? And is there enough evidence to cut and or raise at any given time? The next Fed meeting is on the 1st. And thus far, I don't think anybody has seen any data to conclude that we should immediately cut. So the market has priced out cuts until much further in the year. Looking at interesting site called Shadow Stats, much like Truflation, okay, CPI has been adjusted several times throughout the years. I think recently it was just adjusted in 2023. I think instead of a year over 2 year basis, they changed it to year over year or something like that. But anyway, looking at the 1990s based CPI and the 80s based CPI, we are still much, 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 much hotter than the Fed's 2% target. And again, depending on how you want to look at this data, depending on your interpretation, you certainly could argue for cuts, but you're definitely going to argue, raises, more rate hikes, but you're definitely going to argue for keeping rates exactly where they are for an extremely long time because we are nowhere near close to the Fed's target. So it is just extremely hard to justify cuts. One other inflation input to look at would be gas prices. The Biden administration has said that they are willing to drain the SPR further, which to the chagrin of some people is a negative thing. But look, they're the regime that's in power. They're going to do what they need to do, right? Looking at this gas price for 2024, we've continued to hit new highs nearly every week, certainly every month, and definitely approaching a year-over-year high. So there's no relief in gas prices on the inflation side, certainly. The SPR may change that, but thus far, all the benefits we got from declining gas prices into the CPI equation are no longer with us. And as many have suggested, if Saudi Arabia or Russia or whoever else in OPEC doesn't want to see Biden reelected, they will try to push this gas price as high as they can into the election. And I think that's probably why Biden and the administration is trying to counteract that by emptying the SPR further. just something to think about. Looking at the year-over-year PCE expectations on the nowcast, PCE and core PCE are still closer to the target than CPI. Both are declining. Both are still higher than where the Fed wants us to be. So are we headed in the right direction based on CPE? Yes. Is CPI even coming down a little bit here with 22 days into the month based on the nowcast? Yes. But again, it is not close to the target. Higher for longer means for longer. So we are in the for longer aspect of this. And because of that, again, the market is not pricing in any cuts until September. So we've gone from 6 or 7 cuts expected before the year rolled over to the current 1 cut for the year, and barely that, right? This is like, coin flip territory. So will things start to break with rates this high for this long? Maybe, but I guess we'll find out. So far, so good. In a lot of respects, I think many people are pleasantly surprised that markets are holding up the way they are with rates this high. Something that Lynn Alden has brought up frequently is eventually rates like this do tend to be inflationary on their own if government spending is as high as it is. So there's definitely a yin-yang sweet spot here where eventually the government's going to need to roll the debt. And if rates don't come down, we may all be in big time trouble. We also have a quarterly refunding announcement at the end of the month, I believe. And there will be more commentary on the bills versus bonds versus treasuries mix and what they're going to do there. And that's probably important because previously they had issued more at the front end, and that helped drain money out of reverse repo. Reverse repo, for the most part, we're not seeing a benefit in liquidity anymore because it's basically been flat for, kind of as long as Bitcoin's been flat. There's a lesson there that yes, liquidity is very important, but we're not really seeing this continuing to decline at the pace it was declining since mid-2023. So they really don't have much more to pull out of this slush fund, and that may help pull all of the yields higher. This is since the beginning of the year effectively, and the belly of the curve has continued to move up. The long end of the curve has continued to move up. So this is what's known as a bear steepener. We have not seen the front end come down. We have not seen rate cuts. We've only seen the long end come up. And still, I think the best place to live at the moment is definitely the front end. 1, 2, 3, 4 month. You're getting paid to wait with the uncertainty that I certainly feel in the markets. That's where I'm parked, and any cash, any place I can put it. So not only is our own debt in the United States a problem for yields, as in yields may continue to rise, but the yield curve is still inverted. Okay, so we've got that problem to deal with. Unemployment in the yellow down there is still fairly flat. This is the longest yield curve inversion in history using the 10-2. So eventually the chickens are going to come home to roost here. And this is all of the yields across the board. You can see the long end continuing to rise. You can see the ordering of these durations does not make sense, right? Higher duration should be higher yield, but we're getting closer to uninverting across the board. We're just taking our sweet time. 210 there, still very much inverted, but again, it makes the most sense to me in the near term with rates remaining high to just hold stuff in the short end. And the other issue we've got here for rates is if we've decided to weaponize the dollar, weaponize the financial system, we're kind of opening Pandora's box for the U.S. reserve status. If you're an adversary of the United States, if you're an enemy, if you're a soon-to-be enemy, and you've got FX reserves or you've got treasuries that can be frozen, that certainly would give you pause and encourage you to sell, discourage you to buy. So this is $6 billion of the $300 billion. Russian assets globally have been frozen already. A lot of that stuff, yachts and things, some of those have been auctioned off. But this would certainly take it to another level. We've also got China. This is as of 4 days ago, this story from South China Morning Post saying that they offloaded $22 billion of bills. So if we keep issuing what we're issuing and fewer people want to buy, then yields will come up. I mean, it's supply demand, right? We've also got UJ pushing 155. And should the BOJ want to intervene here, they will sell what they have, which are US Treasuries, to bolster this FX pair. So all sorts of things can start to go wrong here. Nothing quickly, this isn't going to happen overnight, but eventually it's going to matter a lot more. If we uninvert this yield curve with the 10-year above the 2-year, both rising, that sounds to me like a recipe for disaster. So we'll see what happens there. Not only that, based on the risk-off, risk-on mentality, yields on the 10-year Treasury are above S&P 500 earnings for 3 straight weeks, says Lisa from Bloomberg. And it's just all the more reason why in the Sharp world, for the risk-off calculations, there's just less of an impetus to buy stocks here broadly relative to the risk-free rate. Moving into charts here, S&P has had quite a bounce there at 5,000. It's still fairly bearish. There's really no way to beat around the bush there. It doesn't have a bearish TK cross yet on the daily, likely to get that this week. You typically don't see a full-blown retracement through the cloud unless you have a congruent TK cross, i.e. a bearish TK cross here. You can see RSI came all the way down. We eventually broke down from the RSI compression there. But on the crypto side, we'll take this. We will take chop on legacy all day long. What we can't really tolerate is legacy falling off a cliff like it was over the past 2 weeks, because uncertainty spikes, VIX spikes. There are usually reasons for those things, but we'll take this. We will take 5,000 to 5,200 chop. That's best case scenario, honestly, other than what we had over the past 6 months. So I certainly hope we don't break down. It just looks like we will break down. It's recoverable, but it looks like eventually we're going to break down here. The Q is very much the same. This is recoverable, sure, but you can't make this bullish. There's no way you can paint this in the moment that this is going to recover. 395, 400 certainly is still the target. The stop loss on any shorts would be 432, but this is probably going to need lots and lots of time to figure itself out. IWM, very much the same thing. There's no way to slice this that's bullish. What we may see for all these indices is an eventual bullish divergence on RSI, but we are very, very far away from that thus far. VIX, like I said, has come down quite a bit, and that certainly helped the markets. Broadly, some of the geopolitical stuff maybe simmered down a little bit, certainly helping legacy this week versus last week. DXY still looks incredibly strong to me. It's flagging up here. We definitely do not want to see this higher. All sorts of mayhem will ensue if we start to make anything close to new highs above 107, above 108. That's very likely how we see Bitcoin back to 60K or lower. Historically, post-halving, we have seen the dollar devalue itself closer to 90, closer to 80. So that's certainly going to take some time, but that has provided the headwind for us historically if we look back in 2016, in 2020, right? So we're not quite there yet, right? We're not below the weekly cloud. We're not below the daily cloud. The dollar is still very much a strong, strong headwind at the moment. Into some energy stuff here. XLE still looks fine to me. Bounced to where you'd expect on the breakout level. I have no issues with that one there. Copper has pulled back a little bit. Broadly, no issues with this. Again, XLE was up 8 weeks in a row. Copper was up 6 or 7 weeks in a row, something like that. The longer these charts can sort of hang out at the highs, I think the better. Eventually you get selling exhaustion and you get tested on whether or not this stuff is actually bullish or not. So it looks okay. It's not screaming long, but the pattern still certainly very much intact. Back to yields. TLT again is just not the move. Not the move. There's been many people have been holding this stuff for a long time, expecting the long end to fall rates wise. And that has not happened. And I don't see a future where that's going to happen. And at this point, we've almost reached the TA target for the downside on this descending triangle. Looking at KRE, the banking index, that's had quite a nice bounce today. But again, there's not really a trade on most of this stuff. Most of this stuff is just still very much ranging and arguably just as bearish as it had been. Flipping gears to the Mag 7, NVIDIA to me still does not look bullish. It's up 4% today, almost 5%. Great for NVIDIA. One thing us crypto people have to remember is the pace at which legacy moves. It takes a while, takes a minute, right? So I do think this is going to continue to get faded lower. This probably continues to go lower. It certainly leans increasingly bearish. We can measure just this pattern where we expect this to go. It's certainly in that wheelhouse, but I do not see a long setup here at all for NVIDIA, and probably won't for a week, month, it's going to be a while, right? All this stuff needs to reset. Apple as well does not look bullish, right? Again, you tell me in the comments why I should be bullish on a chart that looks like this. I'm happy to listen, but you could highlight the head and shoulders as a bearish argument. That's since broken down. We can highlight this M double top that's freshly ready to break down. The cloud is already bearish. There's just not a lot of reasons to be bullish on Apple right now. Even Microsoft has pulled back. Microsoft had its cup and handle that a lot of stuff was forming throughout 22 and 23. Measuring that higher, it briefly reached the target and has since pulled back. All of this stuff can, of course, continue. It's just in the moment right now. None of this looks bullish. None of it looks like it's ready to reverse. It just all looks like chop. Just mega turbo chop. Amazon also had an inverted head and shoulders, briefly hit that target, had a rising wedge at the top. That's broken down. So I don't really see a technical argument to trade most of the Mag 7 right now. Meta's ready for a bearish TK cross on the daily. And if we zoom out on the weekly, a 50% retrace from high to low would be 215. I don't think that's a realistic expectation, but this thing is certainly in the stratosphere, and I don't know who's exactly excited to buy Meta up here. Google looks okay, only because it never really broke out as much as its peers. So I still think this cup and handle idea is valid. As long as we're hanging out at all-time highs, I think we look fine up here. So overall, I like Google amongst the others. Netflix, same thing with Meta. Again, there's not really an argument for me on technicals why this is a buy up here. Certainly not favorable on trend, and it just doesn't make much sense to me in the moment relative to some of these others that haven't had a run like this. You can always use the channel tool and draw something where you'd maybe expect this channel to hold, maybe bid that area, so maybe slightly lower. Again, you can expand this however you want. That's a realistic possibility. But again, here, what do you do with this here? There's nothing to do, right? It's just sort of hanging out in the middle of the channel. Then there's Tesla, which has been bearish on the daily cloud since January of this year. It had a smaller bearish pattern on this triple top, head and shoulders, whatever you want to call it. It has a broader bearish pattern, which I'd call a diamond. And it has also had, this massive thing, head and shoulders. So there's just nothing bullish about this. The only thing that makes me bullish Tesla is that everybody in the world is bearish Tesla. I just don't even think that's enough to save Tesla here. It just does not look definitive that it's bottomed. I would need to see a pattern. I would need to see something. It's clearly fallen off a table, but it's certainly not bullish. It's got earnings this week, so we'll see how bad those come in. But you've still got the diehards defending this. I just don't understand why. SMCI pulled back quite a bit finally on the head and shoulders there. Fell below the daily cloud. And again, this is not a buy. This is not where you tend to see bullish price appreciation. Just needs a lot of time. Lots and lots of time. MSTR is up quite a bit today, 12%. It's going to bounce with BTC. So there's that. I think overall, this will eventually move back to the midpoint of this pitchfork. There's also the BTC to market cap ratio to consider here. So I think this thing eventually continues to retrace. I don't see a great argument to pick up MSTR. Even here, just still doesn't quite make sense to me on fundamentals. Some other crypto adjacent stuff, Square, which I've been watching on the weekly, looks okay. It still looks fine. I think into Q3, Q4 probably starts to look better. It's not really screaming anything here, but as long as it can hold in the weekly cloud, it has a shot later on in the year. Hood has bounced quite a bit from the top, as in bounced down, but now it's still, to me, on a path possibly to 40. Look, this takes time. Had a nice breakout. Certainly looks more bullish than bearish to me. PayPal also starting to maybe curl up. Crypto adjacent, not really screaming anything, but as a spec buy, I do like PayPal. As far as the miners are concerned, WGMI, pretty decent bounce. Relative to that, diagonal line as support, it's up 25% off that support. Still broadly very much just chop. The miners are having a day because of the fees. That certainly helped. A lot of these miners, as you can probably see on the side here, up quite a bit. Stronghold up 30%. We can go through them real quick. I don't think most of these are necessarily screaming like buy me here. They're doing well. They're doing okay. CleanSpark probably looks the strongest amongst them. Marathon at one point today was down 5%. Didn't really make sense to me. Quite choppy there on the daily. Still not a pretty chart. You know, very, very, very noisy. Very hard to trade over multiple months with a trend. You definitely want to pay attention when we're back above the daily cloud, but down here, anything really is possible. RIOT, very much the same thing, regardless of maybe selling off relative to everything else or being too sold off relative to the pack. The trend has been a disaster. It has just been a ranging mess. Really has not been a great argument to hold on to that thing. IREN looks okay. You know, it looks like WGMI, right? None of these are screaming anything, just very, very noisy. Stronghold, you know, it fell out of the range, trying to get back into the range. Still don't think there's anything actionable on that one. Hut, you know, again, what do you do with this? This thing is a disaster on trend. As a day trader trading this for minute to minute, you know, you're having a great grand old time. But zooming out on this thing, what is even happening? You know, it just looks like a complete mess. Maybe you could argue some sort of triple bottom here, head and shoulders, something, you know, I don't know. There's really, it's just all over the place. WULF starting to break above the triangle here. At least this one is maybe something going for it. It's trying to make higher highs. It's above the daily cloud. I don't hate it relative to its peers. And then GREE, of course, just kind of chilling all the way down there. Let's take a look at coin real quick. That's had a nice day up 6%. You know, I don't think in the near term, any of this stuff is necessarily a great longer term buy. I think you'll get a better price. Coin does have earnings coming up, I think also on the same day as FOMC. So if you're bullish anything listed here, sure. Trend wise, it still looks okay. But to me, nothing is screaming actionability in the near term. Lastly, let's just take a look at ETHE here. ETHE's premium to discount has held around 25% here on the discount side, below the daily cloud for a minute now, back to the midpoint of the pitchfork. And again, depending on your stance on an ETF, you know, I don't think there's anything screaming by me right now here either. I think many people, including myself, are hoping for this discount to continue to increase around an announcement or post an announcement of ETF denial, and then maybe we can talk, right? I think there's a potential, there's a world where we see prices below the midpoint of this trend, and that would make more sense to me. So overall, this trading session certainly better than all of last week for most of Legacy, but we're certainly not quite out of the woods yet and have quite a ways to go here. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.